All right, we'll start. I'm sure people joining in will have a hard time catching up. Thanks for joining. Today, I'd like to talk a little bit about investing in small cap. I'm Mathieu Roy. I'm Vice President Equities at Louisbourg Investments, and our funds are available on the Assumption Life platform. Talking points for today, just like to tell you a little bit about our firm, not very long, and then our investment approach, how we invest in small cap, how we invest in everything in regards to equities, but also small cap in particular, give a few holding example, and show you our small cap product. Louisbourg is based in Atlantic Canada. We have an office, our head office is in Moncton, and we also have an office in Halifax. We have approximately $2 billion in assets under management. Those assets are primarily institutional. We manage all the classic asset classes from fixed income to equities. We have a majority shareholder, which is Assumption Life, and the management team at Louisbourg owns approximately 30% of the firm, which we see as key to maintaining continuity in terms of who manages the different asset classes. We're very much a bottom-up shop. We're very much fundamental in nature. So key for us is our investment philosophy and process. We're all about capital preservation first, whether that's large cap or small cap. Actually, if you're a small cap manager, you can see a variety of methods to try to achieve significant returns. You can take on risk. You can try to go after concepts. Really, our approach, whether it's small cap or large cap, is capital preservation first. And we think the way to add value mid to long term is to avoid losing capital. So be boring, let your winners win slowly, and don't lose money with a few investments which were too risky to begin with. Of course, we want to grow capital, and capital grows a little faster in small cap. And in terms of benchmark relevance, the benchmark is relevant in the way that we want to beat it in long term and have. But in our day-to-day management, the benchmark is only relevant in the investment choices it offers us. We are very different than the benchmark. Our active share is approximately 90%. So if you had an active share of 0%, that would be an index fund. You would own exactly the index. If you had an active share of 100%, you would own 0 stocks in the benchmark. We have an active share of 90%. A lot of our names are part of the benchmark, but our weights would be significantly different. We have very focused portfolios, so something that is 0.2% in the benchmark will be 4% of our portfolio, for example. Names that are 2% of the benchmark we will not own because we're focused and we did not stop on that choice for an investment. So bottom line, we're very much focused on capital preservation. We think that's the best way to grow capital from a portfolio standpoint, and we don't look like the benchmark. We're bottom up. That means we pick companies first. We're not trying to say, what are the trends? Let's pick a name that is going to follow our trend or represent a theme that we may see, a macro theme that we may see in the market. We're picking companies. So we're looking at stocks, not like trades. Stocks are just the vehicle that we're using to invest in real companies. And that's the same for small cap. So small cap is beautiful from that perspective. They can grow faster. Oftentimes they're easier to understand, and that's our first criteria. We like attractive and understandable businesses. Typically a small cap company will have less layers, less divisions, so it's easier to get a good handle on and invest with a lot of confidence. The balance sheet is just as important when you're investing in small cap as well. Oftentimes you can have a bit more concentration when you're investing in smaller companies versus large, so it's important to have very good financial flexibility. And of course, we love a great operating outlook at a very cheap valuation, but our typical investment would be finding businesses that we really like with a strong balance sheet. Oftentimes, our best opportunity is buying a business like that after a weak quarter or two, when the valuation is very compelling, and that we know that we're pretty convinced that the situation from an operating outlook standpoint is temporary. One of the things too, like when we think about the companies that we own in our small cap fund, they typically grow up to become large caps, part of our large cap fund. So names that we currently own in our large cap funds, which are not the focus of the discussion today, were previous big holdings in our small cap fund. Names like Stantec, WSP, Global, Canadian Western Bank, Raging River, Whitecap, Cisco Royalties, all started off in our small cap fund and grew up in our large cap portfolio today by essentially gaining in market price, making acquisitions, continuing to grow organically. So I think it gives you an idea that the companies that we invest in our small cap fund are high quality companies. They're by no means concept stocks or invested in a different way that we would invest in kind of more blue chippy large cap names. The way we construct our small cap fund is focused as well. Our small cap fund, it's very rare that you would find an investor that would have or shouldn't have all of his money in a small cap fund. As such, it's typically a minority percentage of your Canadian allocation, typically 10 to 20%. You don't need to be invested in 60 companies. We invest in 35 to 45 companies that we really like. Typically, the fund will be invested in 30 companies. Again, we have high active shares, so if we don't find any value in a sector, we're not there, but we will have a minimum of 7 out of the 11 GICS sectors represented, and we won't have more than 10% in one name. And we sell like we buy. So we sell a position completely if we get concerned about the business model and or balance sheet, and we will just take profits or reduce our position when we feel that either price has gotten ahead of itself, but we still love the business, the balance sheet, the operating outlook, or still a great business, but the operating outlook is going to be a little tougher over the next few quarters, and the market's not really reacting to it, and the price is not coming off, so we will reduce with the idea of buying back those shares at a later date. Actually, I'd like to use an example from our large cap portfolio from today. Today, Synovus did an acquisition, or last night. We did not like the acquisition for a few reasons. From a fundamental perspective, it was increasing its heavy oil cash flows from the upstream basis, so the business of processing the oil or getting the oil out of the ground. So they were increasing significantly that portion. They're paying pretty much full price for it, and at the same time, they were not getting any more downstream assets. So they were a lot more vulnerable to swings in differentials, which are caused by pipeline capacity, refinery capacity, and they were levering up in the process. So one of the things we liked about the business is they had a nice clean balance sheet. Now they are too levered for our taste, so we made a decision this morning to sell our position completely. That would be an example of a major sell decision where we were selling, in this case, based on the business model, which we found to be weaker post-acquisition, and the balance sheet that we find to be weaker post-acquisition. I think that gives you an idea, and that's exactly the same way that we're managing from a small cap perspective. So why invest in small cap at all? Well, it's greater diversification for your Canadian equities. They don't move in lockstep with large cap. There is sector differentiation between large cap and small cap. But also they're smaller, so bigger you are, the tougher it is to grow. And whether you look at Canada or you look in the U.S. for the past 20, 25 years, indices like the S&P small cap 600 in the U.S. have outperformed on an annual basis the S&P 500, which is the 500 largest company, by approximately 2% a year. So by adding a decent chunk of small cap within your portfolio, you're also helping along the average return that your investor can achieve. Over one period, 1 year, that 0.5% or that 40 beat doesn't look like a lot, but over a longer period of time, we know the impact of compounding. For small cap, however, I think active management is very key. The benchmark for small cap, from my perspective, you'll find a lot more crap, if you will, than you will find in the large cap index. And that makes sense because you'll find a lot of junior mining companies, some concept stocks, some healthcare stocks looking for the newest cancer drugs, essentially a lot of non-profitable companies. There's an appetite for that. Some investors like the risk and the potential return investing in those companies, but they're all part of the index. So we think active management plays even a larger part in small cap land. On the next page, you can see our product, which has had very good returns since its inception in late 2011. It's outperformed the benchmark every year, which doesn't happen very often, but that's what we've achieved. And our average annual added value has been 7% since the beginning. What's also notable when you look at the fund is how boring the holdings are. If you're familiar a little bit with the Canadian market, small mid-cap land, all these companies are not very sexy. Freehold, which is essentially owns land where energy companies can drill on, essentially a royalty play. KP Tissue makes your toilet paper and your tissues. Badger Daylighting, I'll talk about it a little later, but Hydrovac Trucks, Alaris is a financing company with a big dividend. Cisco Royalties is a way to play gold without having any producer risk, so just taking royalties from a variety of mines. So Northwest Company, these are the stores that you find in northern Canada and in Alaska and the Caribbean where it's a monopoly. It's not growing very fast, but there's no competition. So these are small cap stocks. It's nothing. You're not going to find a sexy new cancer drug developer in there. But the key is, the reason we've been able to add value is you don't lose money with those companies. You don't lose your capital, and if you pick the right ones, then they will grow nicely over time. Some of the statistics to back that up is the performance has been strong from a absolute basis and relative basis, but also the volatility has been lower. So we've outperformed, but our fund's actually been less volatile than the benchmark, even though the performance has been stronger. So since inception, it's the standard deviation of monthly return. So how much your return on a monthly basis move around has been lower than the benchmark. And maybe even more important, just to highlight the fact that we invest in quality, boring companies, is when the market's going up, we almost capture all of it. If the fund upside capture in months where the market's going up is 98%, so we don't quite get all of it, but pretty close. But when the market's going down, we only capture 70% of the downside. So the fund is offering good downside protection and showing that the holdings which make up the fund are pretty safe investments. And maybe just to put it a little into context, right? So when you think about Canadian large caps, what's the difference with small cap? In the TSX Composite, there's approximately 250 holdings. The weighted average market cap of those companies, the weighted average value of the company in that index is $43 billion. So there's quite a range, but think about Royal Bank at approximately $120 billion, and you'll find other companies in the $15 billion range, and it works up to an average of approximately $43 billion. So sizable companies. Whereas the index for the small cap, the weighted average is approximately $1 billion. So think about that from the context of a private company, still a sizable company, not necessarily a Mickey Mouse startup, to be sure, but a significant difference in size. And from that perspective, small is pretty beautiful in the sense that they have an above average capacity to grow. It's much tougher to grow larger numbers. So that's what you're getting by investing in small cap, an above average potential return. And investing in our fund, you're getting high quality as well. There's no concept stock, no project companies in terms of mining or anything like that. They're already making money. All our companies are profitable. Our balance sheet is actually better than the TSX small cap index, but even better than the TSX Composite. And what we do is we have a good mix of very small caps, in the sense that they're below 500 million in market cap, which means sometimes that they're not as liquid, but we'll have kind of our larger small caps as well, 1 to 2 billion in market cap, where if we need to move money around, we can do that pretty easily. A few examples: Badger, which has been a holding since the inception of the fund and has been a holding in other funds that we've held in the past, even prior to creating this fund, is since 2009, a very high quality business that offers strong organic growth, creating a new market in the U.S., a more established market in Canada, strong return on its equity, on its investments. And what's also attractive is the income that they're generating translates into free cash, which is very attractive. Even when the market faces a downturn, its balance sheet actually gets better because they're not building as many units. So we find that to be a very attractive business, where it's growing up that we've begun adding that name also in our large cap mandates as a small large cap. And we talked about some of the examples that have graduated to our large cap earlier, and Badger's a kind of a new example of that. Freehold is another good example that shows how we choose to invest. So energy, materials, not for the faint of heart as sectors, but there's ways that you can participate in that sector with above average business models. And Freehold is exactly that. It's an above average business model. It owns the land, but it's leasing it out to companies to drill on it. And the attractive part of that is that it's the other companies spending. So when they're getting cash flows in, Freehold doesn't have to redeploy that to drill more. Other companies are drilling. So that cash flow is going to shareholders or staying with the company, giving it the ability to buy more land packages where they're going to be able to lease out. Freehold really comes from land that was spun out of CN way back when, and CN is still an investor in the company. We're not afraid to invest in business models that we really like. For example, in large cap, it doesn't have to be CN or CP. The rails are great businesses. We own both of them. It doesn't have to be Stantec or WSP, both engineering companies with great business model, generates a lot of free cash, very limited substitution risk for their services, no construction risk in their cases. We own both of them as well. In small cap, we found that there's the franchisors of restaurants are very attractive businesses. So there's operating risk in running restaurants, but being a franchisor where you're getting royalties off of sales is a very attractive business. In the case of MTY Food, they've been able to do that, collect that free cash, continue to accumulate brands, and you can see the growth over the years has been pretty spectacular, steady and spectacular. Nothing sexy, but always a great balance sheet, always a nice diversified portfolio, always generating a lot of free cash. We've taken that business model with a certain twist and recently invested in Freshii, which is a newly public company. And it's similar and different at the same time. It's very similar in the sense that it's also a franchisor model, which is attractive. It's a high return business, both for them, for Freshii the company, but also for its franchisees, and has very limited capital requirements. As a franchisor, it's always very limited capital requirement. But what's attractive here as well is the franchisees that do business with Freshii, that become Freshii restaurants, have low capital requirements to build new stores. So they're not very expensive to put together. And because of that, we feel that it's going to have very strong growth. It's got a stellar balance sheet to begin with. We think the operating outlook is extremely strong. It's not cheap based on recent results, but it's growing so fast that we're just moving out a year or two, and the valuation is very reasonable. Also, you have the optionality that Freshii becomes the next big thing, but it doesn't have to be. MTY is growing its sales. The previous example is growing its sales at 1% a year for the last probably 5 years. It has not been spectacular. But the reason we're still making a ton of money with MTY is because of the free cash that the business generates, and that's why we like Freshii as well. So in conclusion, small is beautiful as long as it's fundamental, which means it needs to be actively managed within a fund, and it doesn't have to be. It shouldn't be speculative as well. We have a fund that's been doing that. It's got a strong track record of outperformance, generating good value, but also doing it with less risk. We find that to be pretty attractive. We're a mid-sized money manager with $2 billion in AUM, so we have the ability. The size of our fund means we can invest in a lot of those opportunities. Some of the larger managers out there, it's very difficult to invest in a smaller entity because it means they would have to own 10-20% of the entity. We have all of those options still available for us. And it gives a client higher returns longer term, and a diversification from large cap strategies. So, that's what we're doing from an institutional perspective. We feel very comfortable putting 10 to 20% of Canadian equities, overall Canadian equities of our clients into our small cap fund. That it's available on the Assumption Life platform, and we'd be happy to answer questions. So I'll take a little pause here and see if I can find a few questions at the bottom of the presentation. Just to read out loud what Brigitte just wrote. So yes, the presentation is available, and if it is requested, it will be sent. Just to answer a few of the questions, yes, the fund is within the wrap platforms. So the assumption portfolios, which are diversified across managers and various asset classes, yes, they are. The small cap is invested in different proportions based on the risk tolerance of the client in the small cap fund. But it's also available as a seg product on its own on the Assumption Life platform. The seg number, I will defer to Brigitte. She'll probably write it down if she knows it top of her head. If not, I'm sure she'll follow up. Well, just on your question, Nova Scotia is great, but I'm actually based in New Brunswick, and it's great here too. The snow is melting slowly. It should be done in a week or so. Just to answer your question, I have to check, but I'm pretty certain that the small cap portfolio is part of all of the assumption life portfolio. If there is one which is excluded, it would be the most conservative one, but it may be there in a small way as well, and we've been adjusting the weight by portfolio. And it's also available from a seg basis. Get the question here, what's the outlook for the next 12 months of the fund? Well, if you would have asked me early 2016, I wouldn't have predicted 43%. It's really tough to gauge what the market's going to return over a short period of time. But really, if you look over the next 5 years, I think the prospect is 10 to 12% a year. I think that's what my thinking is in terms of what the small cap fund can offer. And if you look at it near term, I still see a lot of value, because you think about some of the components, the different sectors, and where the valuations are. Assuming we continue to have a relatively constructive environment like we're experiencing today, I think we could have another double-digit year. Double-digit, I'm planning for 10-12%, but if we get more, that'd be great as well. And in terms of percentage of investment in the fund, the way we look at it is, assuming you have 40% of your overall portfolio in Canadian equities, for example, we would have 4 to 8% of the overall portfolio in small cap. So we'd have, for example, 32% in large cap, 8% in small cap, something in that vicinity. In terms of what I would recommend, it really depends how involved you want to be. Certainly the assumption life portfolios, which offer a manager approach and offers good diversification, is a good way to, kind of a worry-free way to invest. If you would like to be more involved in terms of picking the strategies, having approximately 70% in the Canadian dividend strategy, Louisbourg Canadian Dividend Fund, and then 15% in the Momentum Fund and 15% in the small cap fund, something like that, would resemble what we would do on an in-house basis, and something I would recommend. Somebody asked what my occupation is at Louisbourg. I am Vice President Equities, so I oversee the equities as a group. I also have specific fund responsibilities, like the dividend fund I mentioned, but I'm also the portfolio manager for this small cap fund which we're presenting today. And the dividend fund, we talked about it in the last webinar, but it's one of our flagship funds, so I imagine in the upcoming webinars there's a good chance that it will come back again. In terms to, if we go to cash daily, weekly, quarterly, in terms of how we manage the fund, I'm assuming that's the question. Cash is just a frictional exercise. So, we manage asset mix separately. So the fund is meant to be fully invested. Most of the time, the fund will have between 0 and 6% cash, and it's really on the basis of, we're selling a name. We don't feel compelled necessarily to buy another name the exact same day. We're waiting for a specific price and or event. So that would be the usual range. And I think some of the other questions are things that Brigitte will follow up with you guys, which I would not be able to be very helpful. I do go to Toronto fairly often, so we could organize something so that we could meet. All right, guys, I appreciate your attention. I also very much appreciate all your questions. So we'll see each other again. Thank you.